Okay, so we want to look at the accounting equation. The accounting equation. So what is the accounting equation? The accounting equation is the relationship between the assets of a business and the sources of finance for those assets. The relationship, the mathematical relationship between the assets of a firm and the claims on the assets is the mathematical relationship between the assets of the firm and capital and liabilities. And so it is given by assets equals to capital plus liabilities. This is the accounting equation, and it can be shortened as A equals to C plus L. Of course, this C or capital is equity, and so it can also be written as A equals to E plus L, where E is equity or owner's equity. Okay, so this is the accounting equation, and it's a mathematical relationship. Now, this equation is true and must always be the same, must balance, in a sense that the practicability of it is that when you, for example, you are going to buy something, let's say you are going to buy a cap for use, and you get to the shop previously, you used to buy it for 10 cedis, and then you go and then you ask for the price of a cap, and they tell you that it's now 15 cedis. You are a customer to the boutique operator, so definitely they will not let you go without the cap. So you need a cap. You went with 10 cedis, it's now 15 cedis. So what you do is that you still buy the cap anyway, but then you pay 10 cedis and agree with the seller to pay the extra 5 cedis later. Alright, so now that you have the cap, we will say that the cap is your asset now, if only it's going to be used to generate revenue for you. Now, the value of your cap now is 15 cedis. Okay, the amount of money you put into that is 10 cedis. And now you owe 5 cedis, which is the money that you're supposed to pay later, the credit part of the transaction. And so you will see that the accounting equation is always true, in such that the value of your assets will be equal to what you put into it plus what the source of finance from other people for you. Okay, now let's assume that you went there with 15 cedis and you paid it yourself. It means that the liability portion will be 0. What does it tell us? That whenever asset equals to capital, there is no liability. Or whenever the assets are equal to your equity, there are no liabilities. But cases like this are very rare in our practical business world today. And so this is the typical accounting equation. And this accounting equation gave birth to the balance sheet, or what we now call the statement of financial position. And so we are going to look at how the balance sheet was extracted from the accounting equation. Alright, so just watch this. Now, the accounting equation is saying that assets must be equal to your capital plus liability. Now, taking it from the case of a sole trader, okay, a sole trader enjoys profit alone, and whatever drawings that they make is subtracted from their capital, and whatever profit that they made is added to the capital. And so the C here is the capital base of the sole trader. So if I want to expand this, I will say that assets will be equal to, this C will now be the capital minus the drawings of the sole trader plus the profits that they make. And if it is a loss, it will be subtracted. So this replaces the C plus the liability. What I have done is I have just expanded the capital of the sole trader by taking out the drawings made within the period and then adding back the profit. So this is the net worth of the sole trader, and this is his fund inside the business. Now, this is an expansion of the accounting equation, and it is no different from what we have done so far. Now, to expand the assets, I've already told you that there are two main types of assets. We have the non-current assets, and then we have the current assets. And so I can expand the assets into non-current assets plus the current assets. And then my equal sign will appear. And then I will maintain my capital minus my drawings plus the profit as the owner's equity. And then I will expand the liability into long-term liabilities and current liabilities. And so, ladies and gentlemen, the accounting equation has been expanded into this form. Now, what is the difference between the first equation, this equation 1, and this very equation? There is no difference. It's just an expansion. And I want to let you understand that this is the format of the balance sheet or the statement of financial position. Look at it very carefully. We begin with the non-current assets and this. And then the equal sign comes in, so we have to get the total of this. And the total of this side must always be equal to the total of the other side to make the balance sheet balance. Now, you do this when you are going by the total asset way. Of course, when we get to the preparation of financial statements, we will come back into this and then we'll look at the statement of financial position into detail. But this is just the summary of it, and I'm trying to explain how we got the format for the statement of financial position. This is when you want to go by the total asset way. If you want to go by the working capital way, then of course, working capital, like we said, is your current asset minus your current liabilities. You cannot see your working capital in this if you have the current asset on one side of the equation and the current liability on another side of the equation. And so, in order to see the working capital on the face of the statement of financial position, then you have to transfer the current assets to where the current liabilities to where the current assets are, so that you can compare and check for over-trading. So now we have our non-current asset plus our current asset minus the current liability will be equal to your capital minus drawings plus your profit plus your long-term liability. And this is also the format for the balance sheet. Now, you can either go this way, the total asset way, or you come the working capital way. And when you are going the working capital way, please permit me to put this in brackets, because according to board maths, we have to tackle our brackets first. And so we will always have to find the net figure for the working capital before we add our non-current assets. And then the equal sign means that we have to rule off and get the total. And then we will say that these net assets were financed by, or this capital employed was financed by this. So it was financed by the owner's resources and a long-term liability. Ladies and gentlemen, from the accounting equation, we have the extract. And from this, we present it as the statement of financial position. All right, thank you. Okay. All right, so we want to look at some accounting terminologies, terms that we use in basic accounting. And then I want us to take them one by one and then try to explain and understand what they really mean. So I'm going to start with, so let's say we are looking at accounting terms or terminologies. We are looking at accounting terminologies, and I want to begin with drawings. Drawings. Now, what is drawings? Drawings refers to goods or cash that has been taken out of the business by the owner of the business for his own private use. So drawings refers to goods or cash that has been taken by the owner for private use. And so, like I said, goods or cash makes us understand that we have two types of drawings. We have goods drawings or stock drawings, and then we have cash drawings. So we can have cash drawings or we have stock drawings. So whether it is stock or inventories or cash, once the owner has taken that out of the business for his private use, then we term it as drawings. Now remember that I told you of the business entity concept, whereby I said that the business is a separate person from the owner. And so because of this business entity concept, whereby the business is a separate person from the owner, whatever the owner takes for personal use is seen as not for business use, and once it's not for business use, we term it as drawings. And so it means that the business must use the resources of the business for the business purposes. Once the owner tries to take for the personal use, then we term it as for drawings. And so that is the meaning of drawings. And then also we want to look at expenses. Expenses or expense. Now on this note, I would want to take my time to explain something for you extensively. Now, expense has been misunderstood by a lot of people, and we try to differentiate and we try to mix it up with a word, some words like expenditure. Now take note that there is a difference between expense and expenditure. There is a difference between expense and expenditure. So let me begin from expenditure. Now, okay, so expense is different from expenditure. Sometimes we try to interchange expense and expenditure. I want to clarify something, that expenditure is the main word or the big word. Now, expenditure has two different components. Some of the expenditures that we do are called capital expenditure. And then we have revenue expenditure or recurrent expenditure. So sometimes it's called recurrent expenditure. Now, capital expenditure refers to the expenditure that is incurred on the acquisition or improving upon the value of a fixed asset or a non-current asset. So once we are acquiring a non-current asset or we are improving upon the value of a non-current asset, then that expenditure is called capital expenditure. Now, revenue expenditure, on the other hand, is expenditure that we incur to improve or to maintain the value of an asset. So once we are not improving it, we are not acquiring a new asset, but we are just maintaining the value, then we call it a revenue expenditure. Now, capital expenditure is what we call cost in financial accounting, and then revenue expenditure is what we call expense in financial accounting. And so capital expenditure items are usually recognized in the statement of financial position as part of non-current assets, whereas revenue expenditure items are just written off for the period in the profit and loss account as expenses. And so revenue expenditure is expenses, and then capital expenditure is cost. It tells us that expense and expenditure is not the same. Once you say expenditure, you are referring to a broad classification of both capital and revenue expenditure. But once you say expense, you are just referring to revenue expenditure. So revenue expenditure items are period costs. They are expenditures that we consume within the period and are written off within the period. Now take note that once there is cost is capital expenditure. Once there is cost, this cost is capitalized because we are not going to use it within just 1 year. Remember that I told you that non-current assets are assets that are used for more than one accounting period. So it tells us that we have to spread the cost we incur here over the useful life of whatever asset that we have acquired. And every year, the portion of the cost that is being taken off becomes an expense because we have used it off. So then what is an expense? Expense is the portion of cost that has been used off within the period. Or we can say that an expense refers to cost that has been used up or consumed within the period. So when I buy the item, it is cost for me. Until I have consumed it, it does not become an expense. Every portion of the cost that I consume becomes an expense. So an expense refers to the cost that has been used up or consumed within the period. And that is what we mean by expenses. And so expenses are always referring to recurrent expenditure or revenue expenditure. Recurrent expenditure in the sense that some expenditures are done or are incurred over time, sometimes every month or yearly. You do it every year and then you write it off within the year because it relates to that year and no other year. But some expenditures that you incur that will go beyond the year which you are incurring, we call them capital expenditure. And so these are the differences. We should never confuse expense with expenditure. Expense is recurrent expenditure, and then cost is capital expenditure. All right. Then we can also talk about income. Income. Now, income usually refers to the proceeds that we obtain from the sale of goods and the provision of services. Okay, income refers to the proceeds that we obtain from the sale of goods and provision of services. And so that is basically what income is about. The proceeds that you get from the sale of goods and the provision of services. Of course, revenue is also sometimes interchangeably used with income. Okay, so revenue also refers to what you get from your normal trading activity, the income that you generate from your normal trading activity. But there are some incomes that are not part of your main revenue stream. And so let's try and know the difference. All right. And then I also want to talk about profit. What is profit? Profit refers to the excess of income over expenses. Profit refers to the excess of income over expenses. And so for a period, the matching concept says that we match expenses for the period against the expenses for the period. And so what we do is that we look at our total expenses and then we look at our total income. When the income exceeds the expense, the difference is profit. So on the other hand, if the expense exceeds the income, the difference is called a loss. And so basically we say that profit equals to your income minus your expense. And then if it is positive, it becomes profit. But if it is negative, then we call it a loss. So a loss is the excess of your expenses over your income. And then your profit is the excess of your income for the period over your profit. Alright. Alright, so we look at the next point. We are going to look at the meaning of purchases and sales. Now, purchases. Purchases refers to goods that are bought for resale or stock bought. So when you buy goods with the intention of reselling it, then those becomes purchases. Now, purchase of non-current assets does not constitute purchases. And let me let you understand that there is a difference between purchases. Purchase. There's a difference between purchases and purchase. Now, purchases is a noun, purchase is a verb. Okay, so purchase is just the act. Another synonym for purchase is buy. So to buy, meaning you are purchasing. The present continuous is purchasing. But purchases, when there is an S, it becomes a noun. And it is the name given to the goods that you have bought for resale. You bought them for the purpose of reselling it. So the goods, the name of the goods is purchases, not the action. It is the name of the goods that you have bought. So once you bought those goods for the purpose of reselling, then the name is called purchases at the time you bought it. So once they are goods for resale, it's purchases. Now, if you buy any non-current asset, it's not part of purchases because the intention is not for resale. So let us be very careful with this. Purchases refers to goods that are bought for resale, and therefore sales is our next point. And I also want to add that there is a difference between sales and sale. Sales and sale. Now, when you say sale or sell, then you are referring to the verb, the action of doing it. But the goods that you are selling is the sales. Sales refers to goods that are sold. Okay, goods that are sold. The goods of your normal trading activity that you are selling, that is your sales. And then purchases refers to the goods that are bought for resale. So let us take note. Now, there is also something we call purchases returns. Purchases returns. Now, purchases returns and sales returns. Purchases returns means that you bought the goods for resale, but you found out that from some reasons they are faulty or something, or they were not the exact goods that were delivered to you. So you decide to return them back to the supplier. And so purchases returns refers to goods originally bought for resale that has been returned back to the supplier. And then the sales returns is the opposite of the purchases returns. It refers to goods that has been sold to customers, which has been returned back to you, the business. That is your sales returns. All right. And so I also want us to look at some other terminologies like debtors and creditors. And then, so debtors and then creditors. All right. Okay. So we look at debtors and creditors as well. Now, who is a debtor? A debtor is someone who owes the business, regardless of whatever means the person owes. Whether the person bought goods on credit or somehow. Once the person owes the business, the person is a debtor. And then a creditor is someone that the business owes. So the business has an obligation to the creditor, and the debtor has an obligation to the business. Now, both the debtor and creditors are persons or business organizations. A debtor or a creditor will either be a person, a human being, or a business organization. And so the monies that the debtor owe or we owe to the creditor is also termed. There are some terms like as the debtor's money that he owes to the business is termed as receivable. And then we have payables for the money that the creditor we owe to the creditor. And so what we are saying is that a receivables are monies that are due from debtors. And so what the debtor owes is called receivables. And I told you earlier that when we are preparing financial statements, we prefer to say receivables for assets rather than debtors, because the human being is not your asset, but the money that is with him is your asset. And also payables refers to the money that we owe to the creditors. That is what we call payables. And we have trade and other payables. We will look more into that when we are preparing financial statements. And then finally, I want to talk about bookkeeping. Bookkeeping. Now, what is bookkeeping? Bookkeeping refers to the recording of business transactions into the books of accounts for future references and for permanent use. Now, let us not get this confusion. There is a difference between accounting and bookkeeping. Now, accounting is a recording of business transactions and summarizing them into financial statements. Bookkeeping records business transactions into the books. There is no summarizing. And so, where bookkeeping ends, summary continues to make it accounting. And so I can say that this is a circle, a bigger circle, and I'll draw a smaller circle in it as a subset. And then I'll call the smaller circle bookkeeping, and I'll call the bigger one accounting. And so bookkeeping is part of accounting, but there is an aspect of accounting that is not done with bookkeeping, in a sense that bookkeeping records the transactions into the books of accounts, and that is it. But when it comes to accounting, you go beyond the recording and summarize, interpret it, and then communicate it to the users of financial statements. And so that is the difference between bookkeeping and accounting. Thank you very much.